The oil price outlook is being hit with more bearish forecasts on the back of U.S. President Donald Trump's sweeping and market-hammering tariff announcements. Businesses and investors worry that a trade war and lower global growth lies ahead. Goldman Sachs on Thursday reduced its December 2025 forecasts for global and U.S. benchmarks, Brent crude and WTI, by $5 to $66 and $62 a barrel, respectively, because the two key downside risks we have flagged are realizing, namely tariff escalation and somewhat higher OPEC plus supply. The bank also cut its forecasts for the oil benchmarks in 2025 and 2026, adding that we no longer forecast a price range because price volatility is likely to stay elevated on higher recession risk. Analysts at S&P Global Market Intelligence predict that in a worst-case scenario, global oil demand growth could be slashed by 500,000 barrels per day. J.P. Morgan, for its part, raised its recession odds for the global economy to 60% for this year, up from a previous forecast of 40%. Markets were therefore stunned when OPEC, which produces about 40% of the world's crude oil, along with its non-OPEC allies that together comprise OPEC+, chose not only to go ahead with its previously held plans to increase oil production, but also to nearly triple the expected increase figure. 8 key OPEC+ producers on Thursday agreed to raise combined crude oil output by 411,000 barrels per day, speeding up the pace of their scheduled hikes and pushing down oil prices. The group, Saudi Arabia, Russia, Iraq, the United Arab Emirates, Kuwait, Kazakhstan, Algeria, and Oman, was widely expected to implement an increase of just under 140,000 barrels per day next month. The news pushed oil prices 6% lower,